Alex Cole, my dear friend, welcome to the GoNoGo show of October 13th, 2022. How are you today, my friend?
Good afternoon. I'm all right, yeah.
Markets
Just
are feeling
watching.
a little haunted, right, as we're coming into the Halloween season. Can we dive right into this chart? Look
Are
at
we
that.
going to do this in costume in 2 weeks?
For sure.
I'll be a bull, you be a bear?
Oh, that's a good idea. I was going to go as Gomez. I'm not sure what that means in StockCharts terminology, but this last bar on the right-hand side of the chart, what a crazy day today. Seeing a pretty big bullish engulfing pattern there, Alex.
Yeah, it's funny. I was watching the news pre-market, and we were up about almost 1%, I think. And then when obviously the news comes out about CPI, and we've got obvious inflationary pressures, the reaction was almost 3% down, and now we're almost 2% up. So obviously, investors are viewing that as a bit of an overreaction. Perhaps there's some of that sentiment priced in, and there's a lot of buyers down at these levels. Take it. You can interpret it however you want, but we obviously try not to do that. We just try to react to what we're seeing. But yes, definite bullish engulfing over here on the right. You can see how the high and the low completely encompassing the candle from the day before, and we're really much higher. And you can also look to things like this. If this ends up being a low here, then we've got some bullish divergence coming in with the oscillator making higher lows, price making another lower low, of course. But we're going to still say that the weight of the evidence tells us that we're in a strong no-go trend, and momentum's in negative territory, having had that no-go trend continuation icon just a few bars ago.
Yeah, in the impossible scenario that any of you viewers on StockCharts TV or YouTube or anywhere else didn't actually hear the news, PPI inflation numbers coming out yesterday from September, and then this morning we got CPI inflation numbers from September, both higher than estimated by the economists around the world. So on an annualized basis, we're still seeing about 8.2% inflation here in the United States. What that translates to in the market's infinite wisdom is pricing in further hikes from the Federal Reserve, from the central bank, but also emotions are running wild. Particularly the shorter term you trade, the more of that whipsaw or high volatility action you're going to see. So, just for the sake of viewers, let's take a look at a GoNoGo chart, Alex, on a 3-minute candle.
Go ahead. And just to follow with what you said, in the short term, that volatility is often more in a downtrend, right? Like you've got, at the end of the day, incredibly high inflation is not a good thing. But the fact that we're seeing such a rally today, perhaps some people trying to buy the bottom, some reaction to the overreaction of opening 3% lower. But at the end of the day, we still are talking about really, really high inflation rates. So whether or not that's bullish, you tell me.
Absolutely not. Right. We're looking at third derivative emotions based on the potential overreaction to inflation prices. I got to go back 11 months, Alex. On the Fill the Gap podcast, Dave Lundgren and I got to interview Jim Bianco. This was in December of last year. And he just talked about, the real scenario that the Fed would have to hike rates until they surpass the rate of inflation. In order to stem the tide of inflation, central bank has to bring those rates up equal or above what we're seeing. So to think that we were done 3 rate hikes ago, any commentators that are thinking the Fed needs to protect stock market returns, you're really getting into that forecasting and that behavioral narrative that's so dangerous. Instead, we just want to react to what's happening in the marketplace. So for just the sake of argument, if we were going to be intraday traders looking at a 3-minute candle or a 3-minute bar, how would we have traded today's session so far, Alex?
Well, I mean, that's not to say that you can't fade an overreaction or a huge open to the downside if you're looking to scalp a quick move. And so, if you're thinking today, I bet that the market's going to recover from that, then you can be looking at a really quick chart to try to take advantage of that. Now, that doesn't mean you'd necessarily be holding this position for months thinking we're going up from here, but you could certainly try to get involved in a very, very short-term chart. And here you're seeing that this is a 3-minute chart. You've got the no-go from yesterday. You can see that massive gap down And then, of course, we've really just rallied strongly today. And the first thing that you would have seen was the oscillator breaking decisively out of a squeeze above zero. So somewhere in here, you're thinking, okay, this no-go on a very, very short-term chart may be in trouble. And then you watch it as it rides the zero line again and continues to find support. So, having broken above zero, testing zero, and then finding support, and then you get that confirmation from a go trend being identified on this 3-minute chart. That's how you might be looking to take advantage of something like this. Now, you could have been expecting some resistance here at the gap. We know that the gap or the top of a gap can often act as resistance. So you'd be looking, let's say you take a position here and you're watching these levels and you see no slowdown here at all. That's a very good sign that that move is going to continue, at least in the short term. And then, if you're being very, very sort of aggressive with your entries and exits, you could already be out on this break of the oscillator into negative territory here. So just capturing that quick couple of percent move today, or, the weight of the evidence on a 3-minute chart tells us we're still in a go trend and we've actually regained positive territory now, finding support at the zero line again. So you could be holding on, but obviously that's a very fast moving chart, 3-minute chart. We're only at 1 o'clock in the afternoon.
Yeah, absolutely. We're recording this midday, and so by the time you're watching this, you'll have found out what the right side of this chart looks like. But Alex, let's jump back out to the time frame that we're most frequently using with our clients. These are registered investment advisors, institutional money managers, some long short equity fund managers, as well as institutional traders. And what we've found from them is that multiple time frame approach has really helped them stay out of trouble. So if we're looking at the spiders of the S&P 500, the daily basis might be where we're taking positions, and they're going to look to the weekly basis to see the overall bias of the market. Now, what we have talked about on this show week after week, and what we talk with all of our clients about, is just how seductive and sometimes short-lived those relief rallies are in a downtrend. We also know that we're coming off of a recency bias in the entire year of 2021, where buying the dip paid off very well for investors. Anytime the market corrected or consolidated, that was a chance to pyramid into positions or to buy more. And so the crux of the issue is, how do you know when the relief rally is the beginning of the next cyclical bull cycle, or if we are just in that relief rally and heading lower? So on this weekly chart, the way that Alex and I think about markets is to take a look at the weight of the evidence. So all of the blended technical indicators that are happening behind the scenes, we want to compute and collect all of the data that we can from robust technical indicators like price momentum and our moving average crossovers and our Donchian channels and all of the work that you would put into a responsible technical checklist as a trend follower. But we don't want all that clutter on our chart. Instead, we want to look at a very simple price panel. It's color-coded to give us that information of the trend perspective. And then we're going to look to the lower panel to see if momentum, volume, and volatility are confirming or denying what we're seeing in the price trend. So from a weekly basis, Alex, call it how you see it.
Yeah, we're still in a strong no-go, and you can see that we're making a lower low here relative to the low we had earlier in the summer. Mm-hmm. We had this relief rally that brought us up to the sort of support levels here that became resistance, rolled over. No-go trend continuation, oscillated below zero on heavy volume as we make this lower low. Mm-hmm. So we would be, you and I as trend followers, using GoNoGo charts to try to remove that subjectivity. We'd be pretty wary or pretty cautious of getting too excited after a day like this.
Absolutely. So let's step out from just the S&P 500. Let's take a look at our GoNoGo cross-asset heat map. As we do every week on this show, we want to start from a top-down perspective, getting a feel for the nature of these markets, what's trending, and in what direction. So walk us through, Alex, equities, bonds, commodities, and the dollar.
It's, I love record players, and I don't like sounding like one, but I like to listen to vinyl records. But it's a risk-off picture. We've got equities in a strong no-go. We've got Treasury bond prices, strong no-go. We've got commodities who try to, flirt with those amber bars, rolling back over into a pink no-go. And obviously the dollar, investors moving to cash. That's where you see the strong go trend. And just, again, today is a huge buy. It feels huge, right? 5% swing from opening 2% lower almost. But if you look at today's bar, we're lower than we were a week ago. So, a lot needs to be done before you can get too carried away with a volatile day up in a downtrend.
And that's the power of technical analysis, right? We can compare, we can gain perspective, we can see things in context, and that's a really powerful advantage over investors who do get swept up in news events. The amount of data in terms of trends across all asset classes, getting a real risk-off picture all in one single glance. I think that's really powerful, not to be lost. All right, we covered the S&P 500 and the volatile trading that we've had today. Let's take a look at the TNX, Alex. And if we're looking at government yields on the 10-year, that long-term trend on a quarterly chart, we've obviously talked about that ad nauseum, that break above the long-term downtrend line. But here we are on a daily basis, seeing a series of higher highs and breaking out to new highs on positive momentum.
Yeah, and that's just the thing. You can see here that the Treasury rates found support at the zero line. We got that continuation icon as we now have made a new high on an ultimate high basis, on an intra-bar basis. But you can see, interesting maybe. Is it something to think about, or is it not? Like, the rates have opened lower and gone higher and have come back somewhere in the middle. So not quite as much of a pullback as the stock markets have had a rally. So, take that with a grain of salt, but perhaps interesting.
But the importance of looking at this chart every week is the intermarket correlation. So what John Murphy has taught us all as a CMT charter holder and an intermarket expert is that we can see the correlation between this rising rate environment and the headwinds for U.S. equities and other risk assets. And so as that cooled over the summer, we saw some relief in the rising rates. We also saw the relief rally, right, moving inversely to these yields. And so when we see further upside and rates continuing to climb, as well as the news that from inflation data that the Fed is going to have to remain fairly hawkish to get a grip or control over the rampant inflation numbers, that's just further headwinds to risk assets. And so we need to be allocating accordingly. Alex, let's move on to another macro force affecting these markets. Let's take a look at the US dollar. It's amazing. Last week in Toronto, we had a CMT Association conference and some really great analysts, folks like Azan Habib, Javed Mirza, the great Larry Berman. And many of them talked about the behavioral narratives and how surprising this year was, right? If we go back to our macro econ textbooks, or if we even just look at how these parabolic moves have resolved to the downside, many points along this chart where analysts were calling for the dollar to completely roll over. Yeah. The fact that it hasn't is the signal, right? We're seeing that trend just continue higher in the US dollar, and that's another headwind for risk assets. Alex, what are you seeing right at the zero line? Kind of a weak break out of that GoNoGo squeeze, yeah?
Yeah, just that. Like you said, we're seeing a strong trend in the price panel. We've got those bright blue go bars. But we did break out of the squeeze, and we did see this trend continuation icon here appear earlier in the week. And it's now quickly retesting that level. So we're going to want to see what happens here as we go right back to the zero out of that squeeze. Now, that's not, terribly unusual. Often you see a squeeze and then a little break out of it and then another squeeze sometimes as markets make up their minds and we decide on where directional momentum will come from. So we'll be just looking again to see if it finds support again, and then we'll get another go trend continuation icon. If you've watched us before, you know that I like to see clustering of go trend continuation icons. When you see multiple trend continuation icons, I've found that leads to a little bit of a sharp rise. You can see the same thing here, multiple continuation icons, and then we get a nice little rally in price. You see that break out of the squeeze, quickly retest the zero line, and then off we go. And the same thing here. So we'll be watching to see, does that happen again? If we get support, we'll get another trend continuation icon, and then you could expect perhaps a real attempt at surpassing the prior high here from the end of September.
Absolutely. And currency traders who are trading short-term currency pairs, obviously today was a huge move in the Dixie to the downside. But we're looking at this chart as equity biased investors or as longer-term investors to get an understanding of what that dollar strength means for risk assets. So yeah, certainly still within trend on this daily basis. Alex, if you jump this out to a weekly chart, how does that trend persist now?
Yeah, I mean, you know, it's almost one of the strongest trends you might have seen, right? You can see how when it took hold, went into go bars, then we saw the volume pouring into UUP, and it's been heavy volume ever since.
Mm-hmm.
You know, that's quite remarkable. And then you can see how every time we've had these counter trend correction arrows, we've moved against the trend, we've found support, we've found continuation. Then we have another one, we move against the trend for a couple of bars, and then we find continuation. Same thing here. The last one, it moved, just for one bar. We blew right past that correction arrow.
Yep.
Without even bothering to test the zero line. So
yeah,
very strong trend on the weekly chart.
And there's, don't confuse the top end of that chart with a resistance line. There's a lot of black space above this when we jump out to ultra long-term views. That very large base is resolving higher. So fantastic, Alex. Let's move on and check in on U.S. oil. A lot of analysis happening, not just on the oil space, but nat gas and the energy complex generally. We're going to look at that from an equity perspective in just a minute. But to start with the U.S. oil fund, what are we seeing in this amber neutrality this week?
Yeah, this is an interesting one, and you will see probably if we look at the sector rel map that energy's been outperforming relatively to the market as a whole. And you can see that here. This no-go in U.S. oil is definitely less strong than some of the no-go trends we've been looking at. You can see how we've really struggled to maintain no-go bars. We've got 5 out of the last 6 bars are amber go fish bars. So that sort of inability for the go-no-go trend indicator to paint no-go bars while the oscillator has broken into positive territory. So, there's definitely something going on here that's weakening the no-go trend. And of course, we don't like to predict. We hope to react responsibly. And there'll be a certain resolution in one direction or the other. Given that we're above the zero line on the oscillator, if we stay in positive territory, that'll really give price perhaps the push it needs to move into a go trend. If the zero line doesn't hold, then of course these amber bars may give way to more no-go bars. But definitely something that's really giving the no-go a hard time.
Absolutely. So just from a trading perspective, for long short fund managers, if we were going to trade this on the downside, looking at that no-go, the series of pink and purple bars, the red circles on the top of the price panel, what we're highlighting in that data visualization is the interplay between the GoNoGo oscillator and the price panel. So we want to call to our attention when we see a resurgence of momentum in the direction of the trend. We were looking at that US dollar chart just a moment ago and the long duration uptrend with lots of continuation icons as momentum kept finding support at the zero line. From polarity, from that principle, we know that what was support once broken can become resistance. So if you turn your eye to the bottom of this chart, the bottom panel, once that go-no-go oscillator breaks below zero decisively, we continue to test the zero line, that level of neutrality, and we're finding resistance. We keep getting rejected lower. Every time that happens on the price panel, we're calling that out as a confirmation, as a trend continuation. And so for folks who are trading to the short side, you can have some confidence in those short positions as the price continues to move lower and we continue to see a resurgence of negative momentum. So that's just a little trading lesson using go-no-go charts, but a really key concept about that interplay between trend and momentum. And after all, what trend followers are looking for are those really outsized gains in a long duration trend so that you can stick with them, right? This is the buy back into the dip, or in this case, buy back into the upside price action on a no-go trend. So thank you for that, Alex. Let's move on and check in on one of my favorites, DBA. The inflation data that's coming out is reflecting consumer price indices. DBA is a diversified agricultural commodities fund. We've talked about this throughout the last couple of years in our research to clients. If we are indeed seeing this persistent inflation, in particular food shortages driven by the conflict in Eastern Europe, DBA has taken a long break, but what we're seeing on this chart on the daily basis, certainly to my eye, looks like a real basing pattern. We don't have a sharp trending direction on either side. And Alex, right on that, right where your cursor is, we're seeing a max GoNoGo squeeze. So talk to us a little bit about what you're seeing here on this chart of DBA.
Yeah, I mean, and of course, commodities being priced generally in the dollar, that's going to have significant impact on the price of commodities. And so we're looking at the pattern here, like you said, absolutely looks like a basing pattern. We haven't returned to the lows from July, but we also haven't been able to break above these pattern highs. So we are going to absolutely be watching the oscillator here to see if it can break out of the squeeze, in which direction to see where we will go in a situation that looks fairly range bound. But there is that that overarching thesis that so many people are subscribing to, that long term we're going to see commodities make some gains, but we'll obviously wait for those signals to show up on the GoNoGo charts.
Absolutely. And to sound like a broken record myself, last week in Toronto, we talked to a number of CTAs, commodity trading advisors, who work with a lot of large institutions, right? So these are the pension funds, sovereign wealth funds, the really, really massive companies that are typically investing in trends, late in the 7th or 8th inning of where that's taking place. But as trend followers, they're using these technical tools. And what we know about those money flows from the very largest institutional managers is when they start to put capital to work and they're allocating to systematic trend following and particularly commodities exposure, we know that pension funds and sovereign wealth funds can really drive these markets higher. So if you would, Alex, let's jump this out to a weekly chart, if not a monthly. I'm not sure how far back the data goes, but we've certainly been in a very robust go trend for the last couple of years, and we've just taken a small consolidation. So on a monthly basis, right, if we're going to think about asset allocation and how we're preparing our portfolios for this regime, then we're coming out of a very long structural downtrend in commodities, and we're very early innings for the go trend, at least DBA.
Yeah, and this is the setup. Imagine that you don't know what periodicity this is. This is one of our favorite setups, right? Go trend identified, testing the zero line. We'll be looking for that first continuation icon telling us that momentum is returned in the direction of the trend. This could be a 5-minute chart. It could be a daily chart. This is the setup that we look for. We like to see a go trend identified. We like to see a pullback to test the zero line, and then you can buy that first dip. And this happens to be the monthly, but given that we know on this long-term trend, we're in the beginnings of a long go trend, potentially, then the weekly chart gives us an opportunity to find an entry that might come a little quicker. So if we break it above the zero line here out of this max squeeze, perhaps being aggressive, that could be our entry into that monthly long-term go trend. Perhaps we wait for the weekly to turn to give us that go signal to tell us for sure that this no-go correction is over and that this go trend is going to return. Or perhaps we even go down to the daily and we wait for it to come out of this base. Once we break out of these highs and we get a go trend and we get oscillator above positive territory, we can take that entry, because that's why we talk so much about multi-time frame analysis. If you are looking at that monthly picture, then you are setting yourself up to trade in that direction. And of course, you manage your risk appropriately and you have money management rules in place, but that's what allows you to take sensible entry into a trend that you're seeing on a larger time frame.
And our top-down perspective, when we do a lot of relative strength work on foreign equity indices that are much more commodities driven. So when you're thinking about the Bovespa or even the TSX in Canada, those are showing relative strength against the S&P 500. And for all of us Americans, we've become very equity biased in our view, because a lot of the gains have been driven by Silicon Valley producers. Alex, I know we were going to talk about the XLK and the new lows in the information technology sector, but you and I, we're just too good of friends. If we didn't like each other so much, we could get through a lot more charts, right?
That's right.
But I want to invite everybody who's watching today on YouTube or on StockCharts TV, if you've got the on-demand app to carry this show and many others with you, to join us as well tomorrow, Friday, October 14th at 2 p.m. Alex and I will be presenting that relative strength concept and how to beat a benchmark at the Wealth 365 online summit. Make sure to click the link below and register for that free online event. It's a great time, really great speakers, a lot of CMT charter holders on a regular basis, like Ralph Akampora and others. So we hope to see you there tomorrow afternoon at 2, where we'll dive much deeper into this concept of relative strength and talk about some more live charts. So with that, Alex, I appreciate all of your time today and looking forward to seeing you tomorrow, my friend.
Yes, sir.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.